Good morning and welcome everyone to the Schwab YouTube coaching channel for our Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner. I'm a senior manager with the Schwab coaching team out of Denver, Colorado, and I am pleased to be here with all of you today. I am joined by my fellow coaches here in the chat today. I've got Ben Watson available, and I'm joined by Scott Thompson as well. You can say hi to these gentlemen during our discussion today. They will be offering up answers to some of your comments and questions in the chat, but I'm going to keep a close eye on what's happening there as well because I want to try and bring those discussion topics into our conversation today. So with that in mind, please follow the three of us on X: Scott Thompson, CS, Kevin Horner, CS, and Ben Watson, CS. When we coaches are not offering classes for you here, the X page is absolutely the best place to get started. Now, with that, let's jump to our disclosures and we will get into the fun stuff very quickly. So first of all, please remember that all of our conversations here are exclusively for your information and your education. Remember, we do not make recommendations nor endorsements for any specific approach to trading the market. We do, however, cover technical analysis in this class. We will utilize technical analysis as we review the broad areas of the market with you all. The reminder is that we, in doing so, want you to think of technical analysis simply as one piece of your decision-making puzzle, not the entirety of that puzzle. So we encourage you to make decisions based on a multitude of factors rather than just one, and certainly not simply technical analysis. All right, with that, I want to remind you of our agenda. We take a top-down method approach here to the market, and what that means simply is that we start with our broadest of indexes. We'll hit the S&P 500, the NASDAQ 100, the Russell 2000, and then we'll move our way down the list, essentially, hitting up important industry groups, sectors that are providing leadership, and try to get a feel for what the market is offering us at this point. And then I try to bring in individual equities based on news headlines today. So we're going to keep an eye on a few individual stocks as well. All right, and so with that, let's get a look at the S&P 500. We're going to kick off as we usually do right here. And everybody, we are at a pretty darn important spot, right? We continue to push ourselves into the $7,000 or 7,000 point ledge, excuse me. We've been sideways, kind of range bound in here for about the last 2 to 3 months. And the fact that we've not been capable of breaking through that 7,000, regardless of how many times we've seemingly put ourselves there, does have to be acknowledged, right? So we traders, we are going to utilize the price action as an understanding of how to potentially set our own risk factors relative to where we're putting on our own positions, right? So for a lot of traders, the fact that we've run ourselves to 7,000, been incapable of pushing through it, many traders are simply sitting on their hands waiting for that breakout. And I've been talking about this for the last couple of weeks here on this particular class, the importance of getting through that 7,000 level and holding so that we've got what appears to be a legitimate breakout, and we've yet to see that. Now, for a lot of you, you're watching the daily chart. And for many of you, it's not the daily chart. You might want to see things on that longer term viewpoint. And that would, of course, be something like the weekly. And I'll remind you here, this is a very long range weekly, 10 years, I believe. And so let's kick this back to maybe just the last 3 years. You can see our sideways going on up here, but notice we still remain above the ever important, at least since May of last year, the ever important upsloping green 20-week moving average. And so, reminder, all of us as traders, investors, we all have our preferred time frames. So if you are the longer range investor working to eliminate some of that market noise from a day-to-day basis, you might be paying attention to the weekly chart. You might be watching the 20-week moving average. We are now getting to the 9th month of holding the 20-week moving average. And so those shorter term traders, yeah, you might have some action opportunities before then. But if you're longer range, maybe the 20-week provides that support simply because it's been offering support since mid-May of last year. Now, the other area to keep in mind here is the shorter term traders. Look look at how tight this has become. It's pretty clear. Now, this is a 90-day chart with 1-hour bars, everyone. So if I just zoom into really just back to mid-November here, you can see we had this nice rally from 65.20, and we put ourselves into that peak at 7,000, and that's where we've seen the back and forth, right? So we've established a pretty well-defined trend, and that trend right now is sideways. So for a lot of traders here, if you're looking for that short-term validation, maybe that short-term heads up that something is changing, you might watch this hour-long bars over 30, 40, 55, 60 days, something along that range that'll help you out if you're looking for that early signal that something could potentially be changing. Maybe something like this. All right. So with that, let us look into the NASDAQ. NASDAQ 100 here has struggled a little bit, right? And it's because, of course, we've been struggling in technology. We've seen, and I'll highlight this momentarily when we bust into the sector action, we've seen the lagging nature of technology, and it is weighing on the NASDAQ 100, of course. The NASDAQ 100, the 100 largest NASDAQ positions. This group, of course, is much heavier weighted towards technology, and we have struggled. So I'm going to zoom into the range that we've been in here on the NASDAQ 100. And as Brent Moores and I discussed yesterday, we talked about the importance of getting through the confluence of that moving average snap there, right there, that 20 and 50. So what I've got in orange is the 20-day moving average, just the average price of the last 20 trading sessions. The 50-day in purple, the average price of the last 50 trading sessions. And it's stated commonly in technical analysis that when you get two moving averages alongside each other, what often is viewed is we've got two time frames of traders, two different groups of traders watching the same thing. So it strengthens, or it adds importance perhaps to that level. So we're watching to see, can we get the NDX back above these two important moving averages that could allow this group to begin trending once more. Right now, still sideways and still some overhanging pressure. Now, if you were feeling bearish, some traders would look at the fact that we broke down, made this new short-term low, and rallied into resistance as the opportunity for considering short-term bearish scenarios, bearish strategies. And they would likely be valid in suggesting that. And I'm not saying that that's because you should look at this bearishly. I'm talking about it from a risk-reward standpoint. Let me explain briefly. If we look at these two moving averages and decide that this is in fact an area of resistance, well, then the bear says if we take a bearish position here and we see price action above both those moving averages on a closing basis, many traders would then say, well, I was wrong. I'm going to go ahead and take my small loss quickly, move on, right, and reestablish or reevaluate the trade. Now, the alternative to that is to sit on your hands and be a bull waiting for that break to the upside. So the reason that right now is favorable for the bear is because of the importance of this level right here. Trading above it, now we have a greater percentage likelihood of rallying into resistance where we've been. But if we get rejected here yet again, well, then we have a much greater likelihood of visiting the white ledge down below at what is approximately 24,000 on the NDX. Also happens to be coincident with the 200-day moving average. So we've got a confluence of long-term moving average coincident with horizontal support, which we tested back in mid-November. All right, so what we've got is a pretty clearly well-defined range. But again, technical analysis, it doesn't tell us what's going to happen next, but it does tell us how to set the risk parameters with which we should have comfort. So that's why this ledge here is so important. Can we get through the moving averages on the NDX? That's what we're going to be watching over the coming days and weeks here. Very quickly, the last note here right now, at least, we made our high yesterday in this rally back. And if I pull that oval off, you'll see this a little more closely. So here we had our high trade. in this bounce back. And that means that this low right here becomes the low of the high day. Why is that important? Well, for a lot of traders who are waiting for trend shift heads up, they would want to see, if you're bearish, you would want to see a move in this candle or the subsequent candle tomorrow below the low of our high day. And that would potentially give traders who are bearish belief that we've got a greater opportunity than to trend lower to the 200-day moving average, or perhaps maybe just lower to the last low. We never know if that's going to play out that way, but remember, rallies into resistance followed by a close below the low of the hot day in which you made your high, that becomes the potential for the reversal lower, right? Just like the hold move becomes the potential for your reversal to the upside after a pullback to an area of support. So just a quick inversion, if you will, of the hold move, right? Okay, so let's see how we're looking in our small caps. We're getting a little bit of leadership there today. We're up 0.75%. We held the 20 days. So everybody, we know we talk about a lot of the standard tenets of technical analysis in this class. The reason we bring those tenets to this discussion is because those tenets are important to decision making for the trader who is needing points of note to make those calls, right? And one of those key components is you can trade through an area that should be support, like an orange 20-day moving average here. You can trade through it to the downside on an intraday basis. But do we close above it? That's the key. And that's exactly what we got yesterday with this candle. We had a good start to the morning, right? We had that jobs report that was favorable. It was believed that we were going to be okay. We had a good start. Well, then things changed, and we finished okay, but we actually traded pretty low through the day. So the low of the day brought the bulls back to the table, and we finished right here, okay, at about 2667, which was just fine because we basically on a close have maintained the 20-day now for 1 day, 2, 3, 4, and if we hold it today would be 5. Now, why is that important? Well, as we often will remind you, many traders, you need to define confirmation. For a lot of traders, confirmation is 1 day back above that important moving average. For others, it might be 2, 3, 5 consecutive closes above an important level. The note is not that I know how many days you should be using for confirmation. It's that you should be using confirmation and define your preference for confirmation. Is it 1 day? Is it 5? Is it something in between, right? The most important thing is to have that quick decision-making opportunity, some quick rule of thumb that allows you to base your decision nice and quickly, excuse me. So right now, for a lot of traders, we're in favorable makeup in the Russell by virtue of the bounce off of our 50-day right back here, and then the next one right here, followed by the hold, where we closed well above the high of our low day in the pullback. And now we've managed to hold the 20-day moving average. And so some traders will use the 20-day if they're fairly short term. Others now, given the nature of the rally we've seen since late November, I think a lot of traders are apt to rely on the 50-day moving average perhaps. But again, it's all about your comfort with both risk and time frame for the trade. Okay, so that gives you something to think about with regard to the small caps. And one of the things giving the small caps a little lift is the continued struggle here in the last week with yields. Yields have been pushed lower with the purchasing, the buying of U.S. Treasuries, sending yields down. The fact that we broke the 50-day moving average seems to be kind of notable. This last 3 days has given a nice reversal to the Russell. It's what kind of maybe gave us a little bit of that shove to the upside in the rut. Versus the yields dropping. And so we know that that's a yield sensitive group. So we try to bring these two together. When we talk about the Russell, we try to talk about yields as well. We'll see how this plays out. Yesterday, we did discuss the CME Fed tool, the third party website that details how traders are positioned regarding the expectation of the upcoming FOMC meetings. We do have in most close to us is the one coming next month in March. But if you want to learn more about that, check out yesterday's class. It's already in the archive, ready to go for you. Okay, so there's a quick look at your big three: the S&P 500, the NASDAQ 100, the Russell 2000, and yields. Let's check in on semiconductors here. Semis are doing okay. Moving, looks like we made a new high here. New intra-period high. Waiting to see if we get that as a close. This has been wide ranging. As you can see, the range between our peak and our last bottom is not small on this. It's actually 12%. That's pretty wide for such a substantial move. So, or group, I should say, excuse me, meaning 12%. We should note that. That's big. Now, the question is, do we get that breakout, right? We've certainly seem to have confirmed horizontal support and the 50-day moving average as maybe trend support. So we'll keep an eye on it. But a breakout might mean that we need to monitor one of those faster moving averages. So for some traders, that's the 20-day moving average. Let's see, there's the 20 by itself. Look at the 50, though. The 50 does seem to be quite clean on the semis here. Your instances beneath it have been few and far between. And when beneath it, it's once confirming support, you've been provided opportunity to join the trend by when it gets back above the 50 days. So some traders will take that approach as well. And when you look back, yeah, we've basically been above the 50 days since May of last year. So we've been pushing, and the question now just becomes, do we make new highs, right? So we'll see how that plays out. But the semis are at the upper ledge, not yet breaking out. We'll see if they can push a little bit further. And then, of course, we've been talking about the transports. We did a deeper dive yesterday into the transports, looking at the components. This group is elevated. You'll notice that I'm going to activate my oval and highlight the entirety of our RSI, excuse me. RSI is into overbought conditions, but I do want to mention, remember, overbought can stay overbought far longer than we expect. If we're looking at the RSI for a potential sell signal, the way that some traders will utilize this is that they will maintain position size in standard as long as it holds the breakout. And then with a signal of weakness, you've got a few options, of course. Maybe you're going to use, a trader might use something like a 10-day moving average, nice and quick, very speedy. They might use that. They also might just say, I'm going to pay attention less to the trend moving average of importance, and maybe on a close in the RSI under the overbought condition, they may lighten up their position there. And again, that decision to lighten up versus selling the entire position is at the trader's discretion. The reason, though, that a trader may very well sell just a portion is to reinforce the good habit of being the trader who says, I've got a good move, I've reached a point of profits, I'm going to take a little bit of risk off, and then see what happens. And what inevitably occurs in the instance of a group that continues to run in the bullish favor is that the trader is afforded the chance by simply selling a little at peaks. They end up being able to maintain a much larger run. And what I mean is not size, but length, longevity to maintaining the trend. So what you're ending up doing is managing your emotional tie to the trade and to your dollars invested. And so by selling a little along the way as you reach a peak, give yourself the chance to see something occur after the fact. You've got less dollars invested, the stock pulls back or the group pulls back, and then you're finding the 20-day moving average and you're saying, great, I've got an opportunity to expose new money yet again at an appropriate area of support, a trend support approach. It's very common. It's definitely something that takes time to work with, of course, but having those plans and sticking to those plans and making these decisions to sell a little, buy a little, add to your portfolio and subtract from the portfolio based on price action is a way that traders are participating actively. And the key to that, of course, is, as I often say, the key is to know what it is that makes you, encourages you to make those decisions so that when the market moves, inevitably it's going to move at quicker than you'd expect at some point. So the key there is to be prepared, even for moves you don't think should be happening, so that you can make a quick decision. The challenge, of course, is being surprised by decisions or by the way the market moves, and then forced to make a decision on the fly, and doing so with emotion. That's where it becomes very, very difficult. All right, so now we've hit up these big components, right, of the broad market. Let's do a sector review. We're going to start with our Market Watch tab because we want to see how things are laying out. Now, I've got the industry groups in here across the board. So what we're looking at here is everything. Let me highlight how I've gotten here, everybody. So we've clicked on the Market Watch tab. We're on quotes. And if you click the drop-down menu here, go down to public, this is the sectors and industries. So this incorporates all of the sub lists available, right? Now I'm going to select sector indices, and that's going to give me only the 11 sectors of the US market. Silas, I can answer that for you here. Let me give you the quick answer to that. The question is, what is up with the 5, the link on the left-hand side? How do we get that in there? That is, of course, one of your column options. So just a quick 30-second teaching moment for all of you. We're going to hit the gear icon here in the upper right, select Customize, and what you're looking for is Send To. So here in the lookup column, you just type in send, and now you've afforded the chance to select your proper color. Why do I have that in there? Well, I've got my screen and my layout of Thinkorswim spread over multiple pages, of course, so I can look at the data on this screen on my left, and on my right, as I click, I can hit the number 5 here, for example, to see the energy space, and then I can go to my chart, which is also on the purple, and now I'm looking immediately at energy. So just a quick little note there for you. Always be considerate of the benefit of linking your tools together, of course, and move forward. But I'll tell you, the look we've been talking about here in energy is notable. Let's put all our moving averages back up there. Boy, look at how quickly, still well above the 20-day moving average here, everyone. We're about 65 points above it. 65 from where we are to the 20-day. So for a lot of traders watching energy, we are not really able to utilize the 20-day because you're giving up so much of profit opportunity from where we are. Right now, we're at 848 and change. So let's just draw that line down to the 20-day. So as an example, everyone, if you were going to say, I'm only going to feel like the trend is broken if we get a trade under the 20-day moving average there in orange. That means, as the box indicates, you got to give up 7.5% just to find that horizontal or that trend support. So the trader has to decide, am I comfortable giving up 7% to the downside before selling, or would I be more comfortable just selling, 5% of what I got up here at this elevated level, and let's just see what happens, because the market will run for a while, right? You'll get these runs. The question isn't how long necessarily, but how long can I manage the trade properly, comfortably, etc. So consider the proper moving average. In this case, when you're looking at the energy space, it looks to me like the 10-day has been offering the greatest amount of speedy support. We've been above the 10-day on a close all the way back to here. This was December 29, it looks like. So really great trend of late. You're looking at about a 6-week push utilizing the 10-day moving average. At some point, that's going to change, but it hasn't changed just yet. All right, so energy, our biggest leader on a year-to-date basis. Let's sort by year-to-date. So quickly, I just want to mention the fact that we're noting not just the return detail, but the fact that our leadership is in these traditionally defensive groups, those being energy and materials and staples, industrials, real estate, utilities. Where are we most commonly? When we have the bull market we've been witnessing for the better part of the last 3 years, but dating back to the beginning of 23, for example, we have been seeing leadership from discretionary and technology and communications, right? These are your big boys, your Apples, your Mag 7s, right? Meta and Amazon and Alphabet and so forth, NVIDIA, obviously. But that is all under pressure right here. And when you look at tech and communications, discretionary, and suddenly now financials, everything in the red, the trader starts thinking, well, why would I work with things that are not producing, right? And that's essentially what a lot of traders are going through right now. Is trying to figure out, should I be trading the stocks that I've been trading for the last 3 years because I'm comfortable with them, or at least I think I know what they're doing? Or do I fall back into standard technical analysis concepts that encourage trend traders to look for stocks that are already in uptrends, buying stocks that are currently moving in uptrends or that may have turned a corner into potential new uptrends, right? What we're learning from this visual here is that maybe we should be deepening our viewpoint. We should be looking at other areas. Now, one other note, if you wanted to see a chart kind of visual of this expression, the other thing that I should have pointed out earlier was the movement in something like the S&P 500 equal weight index. So what is this? Well, it differs from the S&P because the S&P is built on size and weighting, right? Cap weighting, whereas the equal weight is built on evenly distributed percentages associated with all 501 companies in the S&P 500. So what we're seeing out of this is that leadership is important, but the fact is this group, this S&P 500, is not being carried by technology. It's being carried by those other groups that otherwise are not part of things like the NASDAQ, right? So when you see the NASDAQ struggling, we know why. It's because technology looks quite similar. Take a look at tech. See, we got a downtrend here still, right? Now that doesn't mean that we aren't that this isn't just a standard pullback, right? Certainly could be viewed as such. Percentage-wise, from our just about 6,100 to our low, we got a sell of about 13.5%. So a lot of you traders are going to say, that's pretty standard, Kev. We made a new high, and now we've spent the better part of the last 3 months retreating to an important moving average, in this case, the 200-day. And you'd be well within your right to take that view. In fact, we haven't visited the 200-day until last week since we broke it, right back here in May, right? We broke it, we tested it, and then we rallied. Well, here we are again. It's been tested. We've traded off of it with a hold move right here. And granted, we are still in our downtrend, our series of lower highs below the 50-day, at the 20-day. Not ideal, but if you're trend trading, you have two options, right? The trend trader who's bullish can look at technology and say, all right, I am going to wait until we trade above the downtrend line on a closing basis, which just so happens to be the 50-day moving average as well. Or that trader says, you know what? I'm going to look for entrance near support. And they view potentially the 200-day moving average as support, in which case entrance here at this ledge would give them a better risk versus reward. Same thing would be the case, though, waiting for the breakout. Some traders like to trade the breakouts of the diagonal downtrend line and start a position when the trend line breaks. Others want to be buyers near support. Doesn't really matter. What does matter is that you know what your plan is and that you adhere to that plan. Now, if the trader did wait for an opportunity to be buyer near support, they might set an exit strategy that would have them moving on if the sector made a new low under the one we just made last week. As an example, that would be perhaps a development that a trader would say, yeah, on second thought, I was wrong. They might move on. All right, but that's what we're waiting on in tech. We haven't seen it. Now, if that changes, hey, then we may have something else to discuss. But right now, the tech group is heavy as it relates to the rest of the market. It is not exclusively heavy, of course, because we've noted semiconductors trading at highs. But as an example, one other area here that we have been talking a lot about this last week within technology is software. And software has just been absolutely beaten down, as you can see. We've had a couple of significant breaks here. So we had a double top. We had a neckline of the double top. The double top moved and made a lower low, rallied into the neckline for a check back and fail at resistance. And then once we did that, We rolled over yet again. So there's been a very, from a technical analysis standpoint, what a lot of traders would suggest, a fairly well-structured sell-off. And what I mean is, we can't say it's predictable, but we can say that when price action broke down through this ever important neckline of the double top, that support became resistance. And so the likelihood was, yeah, we can bounce back into that. Let's see if we can push through it. And clearly we could not. We were there for 2 days, made a move lower, tried to rally back, made a lower high, right? Lower high, bearish. And then we made a lower low, then we tried to bounce, and now we've just been riding the 20-day. Why am I talking about it? Well, because it continues to be heavy, continues to have this bearish move. We've not yet seen software get off the mat. So you got to be aware of it, and you got to be aware of the break of the component breakup, or the component makeup rather, excuse me, of the sector. Because even though tech is struggling, and you can clearly see two very big discrepancies between tech and in tech, between semiconductors and software at this moment, right? Okay, a couple other looks here. We've been getting our leadership, as we talked, from materials. The one thing we didn't hit on yesterday was the look at materials. Really just a continued move, working against the 20-day moving average here. Big move off of the 20-day back on January 30th. In fact, we've managed to see almost a 10% rally in this sector. My goodness. This is not standard behavior for the materials sector, I will mention. This is a big move. Let's see how this looks on a little more long range. Okay, well, there's your 3-year chart. We talk about breakouts frequently. Why do traders like breakouts? Well, commonly, when a breakout occurs, if the trend is going to carry, it's going to start trending quickly. And that's what we've gotten here with materials. Materials is not alone, though. There's been some other groups that have turned the proverbial corner here quickly. What about utilities? Interesting, right? Why are utilities rallying? Well, what have we seen from yields? Yields suppressed, yields going lower. Utilities broke a downtrend, depending on how you choose to draw it. I'd probably put it right about here. And again, as Ben called out, or Scott called out, where was it here? Something about the diagonal breakout, right? Look at this. Break the diagonal, pause and breathe a little bit, and now we've got a slingshot move off the 20-day here. So utilities have rallied aggressively. Again, yes, it's tied to the rate move in all likelihood, we've noticed. So traders and investors here are definitely feeling like they're willing to take on a little more risk for a potential improved return versus that of the 10-year bond, the treasury note, right? Because that's the so-called risk-free rate of return, implicitly backed by the US government. But here, if you're buying into utilities for the increased interest or dividend opportunity, and carrying with it the capital risk that come from owning an individual equity, well, clearly traders are feeling like this is an area that they can get more exposure to. So this is interesting. Horizontal resistance, yeah, we could say that. That could mean a pause. I think one of the hardest things for traders is getting understanding maybe the difference between resistance acting as a spot for a pause to the recent trend versus acting as a spot where we're going to see rejection. So if we're going to, and this is just another discussion briefly around management, if you're a trader watching this rally into resistance, and of course, your entry to a position like this has everything to do with how you manage it, right? But a rally like this in a group like this, where we're talking substantial percentages over small windows of time, this here says 7 to 8% to the upside. And if we paused here, that wouldn't be bad. But what does a pause look like? What is the key that a trader says, all right, now I'm going to take profits? Maybe it would be a move back below the low of today. You have a gap in here. Okay, and if this today were the high, of any rally, well, then some traders would say, all right, if we close below the low of that high day, I've got reason to pull a little bit of my risk from the table. And so they might do that. They might see what comes next, and then they might reapply those shares after a breakout, or they might just never reapply those shares. They might just say, all right, I pulled a little bit of profits. I applied that to a different trade, but I've held the majority of my position. If it breaks out, great, I'm still participating. It's one of the reasons so much that a trader will tell you, yeah, I'm comfortable selling along the way, because they like to be right multiple times. If you sell at resistance a little bit and the stock breaks through resistance and keeps climbing, you were smart to have held many of your shares, right? But if you sell at resistance and the stock pulls back aggressively, well, you were smart to have sold some while keeping some. Smart to have taken some off the table in advance of it pulling back. So again, trading is so much about managing our own emotions. It's very important to have that specific plan that'll make it easy for you individually. It's very different for all of us. Now, we can also look quickly at real estate. Reminder for you, wow, big move here in real estate of late. The reminder I want to offer you as it relates to the real estate group, oh, this is intriguing, is that this is much more REITs, real estate investment trusts, not specifically, not specifically the home builders or construction. Remember that investing in REITs, that poses additional risks that are tied to real estate and the industry, of course. So make sure that you're familiar with that. The trend situation here is pretty intriguing, though, right? Because we've been going sideways here since April of last year, or May, and sideways, sideways, sideways breakout. And I just said it a moment ago, we break out of a sideways or consolidation. What is the potential? That we start trending thereafter. Now, just as potential to continue this uptrend and continue moving to the upside aggressively is always the potential for a throwback to the breakout spot. So I'm going to change this line. We're going to push this out a couple of weeks. And I'm going to make it green as the reminder that it is now potential support for me. So any throwback to the green that is confirming support might be an entrance for new traders looking here. But again, interest rate sensitive group. Now, the other interest rate sensitive group, of course, we got to talk about, we're going to talk about home builders. And because I'm going to expand off of the REITs, we're going to look at one of my Dow Jones symbols here in the home builder space has been improving, right? My goodness, this is a kind of going against what what many are suggesting, right? Because when we're looking at the home building space, yes, yields are retreating, probably giving lift to the space, but the narrative is that housing is not really breaking free just yet in terms of sellers and buyers. We're not seeing the movement, but we are seeing something developing here. Most notable for a lot of traders is really all of this action. Look at the slope of the long range 200-day moving average carving out a bottom in here. And now that slope is gently to the upside. And what we're seeing here, a 200-day support test, another 200-day support test, and now have moved through a potential zone of resistance, now possible support. So this seemed to call things out to me a little bit, something that was notable, not having moved through to new highs necessarily, but it does bear watching. So when you're going around scouring or scanning, searching the market for your opportunities, be thoughtful about it. In fact, there's always a way to go about your scanning process that leads you towards your leaders. Maybe you're looking into small caps because they are leading at the point, or maybe you're looking into transportation as an example, and you want to find the leaders within that space. Buying into groups that are providing leadership broadly in the market, and buying the leaders within those groups is one way that traders will go about things. We refer to it as fishing in a well-stocked pond, right? Doesn't mean you can't find your opportunities in technology at this moment for a lot of you, but at the same time, it's a struggle. It's not the same. Right? So we have to be aware of that, and we've got to be, I often say, we traders, our job is to be a chameleon in the market. We have to move with the market. The market shifts frequently. We need to move with the market. Now, yesterday, one of the things we didn't get to, unfortunately, was to discuss precious metals, and I wanted to do that briefly with you all. So I'm going to pull up the futures symbols for gold and silver, and I'll just remind you that futures and futures options trading, this involves substantial risk, of course. Is not suitable for all of us as investors. You do need to be familiar with the risk disclosure statement for both futures and options, and before doing so, you do need to be approved to trade. So make sure you're going through all your requisite steps there. Here's a look quickly at gold. The gold move off the 50-day has worked. It's bounced well. You've seen a push off of about 4,400 back into 51. But the fact is, we've clearly not been able to get through this 5,100. Now, it doesn't mean it can't. It means it hasn't. So right now, our responsibility is to take a look at this level and kind of define it as a zone above which we can maintain bullishness, and if we get rejected here again, it might mean we just need more time, or it might mean that the rally's over. That's not for me to say, obviously, because I don't know what's coming next. But what I do know is that bulls will be more likely to be believing that there's more upside on a move through about 5,100 on a closing basis. This is a pretty important level, being that we've moved to it 3 or 4 times here and have clearly, there's your 1 hour look. Yeah, you can see we've been there. So do we trade under, the lowest low we've made in just the last week? Maybe. I mean, what happens if we traded back under 5,000? What changes from your opportunity standpoint? I think for many traders, if we saw gold back under 5,000, just from this bounce, this trend situation, the potential is to see this, the odds increase that we have an opportunity to see 4,400 again. All right, let's take a quick look at silver. There you go. Something similar in silver, although gold got you back above the 20 days. Silver has been more in settle in mode. The conversation around silver was tied to more of the, let me see how to put that, more of the use of silver, right? Silver has use and value relative to the economy that is not, it's like gold. Gold is essentially precious metal and nothing else, right? But silver has actual usage opportunity, and I think there was some discussion here that, oh, this is the next wave of opportunity, and you see that this thing exploded from mid January here. We rallied all the way. That's 66%. Now, that is not a sustainable rally. That looks like, after the fact, looks like what many would suggest was a FOMO rally, and it sure went that way. Well, we've kind of confirmed the 50-day as potential support. The question now just becomes, can it maintain? And I think a line at the 50-day makes sense for a lot of traders. Under the 50-day, again, probably an increased likelihood of additional weakness, but the bounce back has been muted, I would say. And when you look at what's going on here, you don't have a new continuation of the uptrend just yet. So I think that makes it's important to keep an eye on silver. Doesn't necessarily mean that traders should be plowing back into silver. Okay. Boy, that went quickly today, didn't it, everybody? I'm afraid we are just about at time. And so what I'm going to do here as I wrap things up, I want to go quickly to our page on coaching. Just remind you all that you have an opportunity not just to attend other classes with us, but to also attend our on-demand webcast. So everything we do here on the channel for you is available at schwab.com/coaching, and you can absolutely reference this stuff at your convenience, continue your learning. We invite you to do that. Don't forget, you also have access to our free in-person events. Here is the schedule. We'll be in San Diego for our market drive. Just a heads up, our workshops differ from our market drives. Our workshops are 2-day events, both technical analysis and options, and then an advanced options class. And then in those workshops, we ask you to bring your devices. You come out, we give you power and Wi-Fi ready to go, and we take you through an in-person walk through and workshop. It's a very fun experience over 2 days. The market drive is more analytical, if you will. We talk about the existence of where we stand in the market, what is moving the market, what are traders watching, and we bring all kinds of conversation to the table for you. Generally, a third-party guest and conversation on the stage with you, and a really fun event. And I, as a coach, can't tell you enough how much I love these events. Love getting there, love seeing all of you there. So come and visit us if you can, everyone. And then don't forget, you definitely have access to the channel. Use the channel as much as you can. We'd appreciate you being subscribed here as well. So today, big thanks to both Ben Watson and Scott Thompson in the chat. I want to thank you all for joining and participating as well. Hit that thumbs up button for me down below, and that'll help us out as we get this reviewed and into the archive for you all today. And make sure you're subscribed to the channel and follow the three of us on X. Ben Watson CS, Scott Thompson CS, and Kevin Horner CS. Always appreciate hearing from you, everybody. Hope you have a fantastic Thursday. I look forward to catching up with you all again real soon.